Well, again, hello everyone. Thank you so much for joining us this evening. Before we get started, just a quick housekeeping note. Feel free to drop any questions in the chat as we go along. We'll do our best to answer them at the end of the session. And this webinar is being recorded. We will be emailing you guys at the end of this week the recording. So you're welcome to share it with friends and family who might be interested. Most of you guys know Beau already, but for those who are new, quick little intro for Beau. Beau is a Wall Street Journal and USA Today bestselling author. He just released the 2025 edition of his new book, Social Security Clarity, which also includes the most up-to-date strategies. Tonight, though, he'll go over current market and up-to-date on what to do next. We will be providing you with multiple resources at the end, so stay tuned. Without further ado, please help me welcome Beau.
Thank you, Anna, and welcome. Welcome, and thank you for taking some time to come out tonight, have a little conversation around the market, the headlines. I'll stretch and say some of the noise, and what do we do when it comes to retirement planning. And as Anna mentioned, stay around because we did put together multiple resources that we're going to get in your hands because one of the things, and part of this conversation tonight, it's about clarity. All right, conversation. Let's check data. Let's get clear on our current situation, and that will alleviate some of the things we've been seeing, hearing. Let me start with something. So April 2nd, these are headlines. Recession fears resurface as Fed talks tough. All right, panic, fear, emotion triggered. April 3rd, markets tank after surprise tariff announcement. Alarm, emotion. April 4th, stocks rebound sharply as investors see opportunity. Little relief, little confusion. April 5th, Wall Street on edge after tech sell-off. Worry. April 8th, markets rally as AI stocks soar, Dow up 500 plus points. Euphoria. Let's go to April 10th. Biggest week for Nasdaq since 2022. What comes next? Speculation. April 11th, Dow jumps 5% and wildest week since the pandemic. Whiplash. I'm not done. April 12th, should you get out before the next crash? Doubt. And April 13th, is the worst over? Analysts say it's time to buy. A little hope. And I started with those headlines because it's been crazy, right? That's just in a couple of weeks. And I wanted to start this conversation is just check in with everybody. How are you doing? Right? A lot of noise, a lot of sound bites, a lot of things. The reason I read those headlines is those are intentionally generated to create emotion. Takes a lot of energy. So just checking in, stressed out, worried, optimistic, hopeful, all of the above, any of the above. So just want to check in for those of you here. Just how are you doing? It's been a crazy couple of weeks. As we get into the conversation around what does all this have to do with my retirement? And as I started, I think as we talk through and we have good conversations and we look at data and we step back from the noise, it really helps alleviate some of these emotions. So let's dig in. First thing I need to do is my disclaimer that today we're talking about some ideas, some concepts, some data. We're not doing any specific tax investment advice. If we need to get into that, that's more of a one-on-one check with the team. You can ask me specific questions there. This is big picture overview concepts, right? How do we approach retirement planning, even when the world's crazy, even when all the noise is out there, and still have some predictable outcomes? When some days I think the message is that is far from possible and I think it kind of plays on us as humans because response and response in the form of clicks, likes, listens, reads, again, elicited by emotion. Let's start with this idea of navigating market uncertainty. We talk, the headlines talk of tariffs, right? When we look at data, we look at history, tariffs can have short-term historically have had short-term, maybe repercussions or negative consequences in the market. But typically when we look back long-term, the market goes back and it's back higher than normal within 1-3 years or so in the timeline. Again, somewhat of a short-term noise with that. But one thing, when we look at the indicators, when we're figuring out how do we want to navigate this from a portfolio standpoint, we're checking things like unemployment, we're checking things like inflation, we're checking things like interest rates, and all those things aren't out of whack. And sometimes when we've had this long tail or this long track of a market going up, it's easy to lose track that the correction is part of what makes it reset and grow healthy again. And we're only in a bad position if we're not properly structured. So one thing for those of you, a lot of you are clients here on this conversation, we structured your retirement strategy. It's built for this. It's built for the volatility. It's built for the down markets, because when we build the way we do and we segment the way we do, you have income and you have time built into your retirement strategy to withstand the noise and the short-term volatility of everything that's going on. Now, one of the worst things we can do is react and do things that aren't in line with a plan that's already built, again, to withstand the ups and downs. Now, when I get to this conversation, the navigating the market uncertainty, one of the things in planning that I do not think is addressed enough, I already hit a lot of interest rate risk. We talk about the market risk, inflation risk. We could go on and on. The risk that's not really talked about enough and planned for is the risk of uncertainty. One thing I am certain about is that there are things that are uncertain in our timeline, in our future, in our retirement, right? How long we're going to be healthy and active. If we're still working, how long we're actually going to work. The plan might be 4 or 5 more years. It might not happen that way. When are we going to die? Right? We don't know those things. So when I say, how do we plan for the certainty of uncertainty? We build a strategy, or we put your puzzle pieces together in your timeline in a way that it holds up, it works regardless. If you die too soon, it works. There's a contingency. If there's a surviving spouse, there's a contingency. If you live too long, it's built to withstand inflation for the long term. So how do we prepare for the certainty of uncertainty? Is we build plans that already know that there is going to be uncertainty in our future. Otherwise, if we're assuming that things are going to work out a specific way, or worse, thinking that things are going to work out exactly the way we want them to, we're dealing with humans and we're dealing with life. Okay, that's not real. But if we make those assumptions, then we can build a plan that when we're going through things like this last couple of weeks, you didn't lose money. And you probably have 5, 10 plus years for the market to do what it does best over time, help act as a hedge in inflation, get higher averages over time, because you structured your retirement strategy properly. So that's really what I want our conversation to be about today, is if we've structured our plan, our strategy properly, we can step back from some of this emotion that might be driving some of us absolutely crazy. And I get it. We talked about the market's unpredictable, volatility is expected. The market goes up and down. Sometimes what happens, again, we remember the good until it turns, and then we don't realize that is a reset. And if you look at this chart, I want to show you this. Every reset, some of the biggest gains in the market come right on the backside of the reset. And you know what? The market always recovers back to where it was and grows. And again, to reiterate, the only way that's a problem is if we were guessing or gambling and we're counting on money to live off of that's currently at a loss. We didn't do that at RichLife Advisors. So for those of you here, I want to, one, talk about the structure of the planning, and two, are there adjustments? Did this bring to light some adjustments that maybe need to be made? Or some awarenesses of, hey, maybe with the growth of the last decade, there's some rebalancing that needs to be done. Maybe with some of the inflation we've experienced, we need to make sure our income plan accounts for a little more income coming in so I'm not stressed when the market's down, and I'm fearful that I'm going to have to access assets that are currently down. So the market recovers over time. And what do we do with that? Before we get into that, one of the things I'm going to talk about is there's a couple things. And I started with those sound bites intentionally because a lot of that noise, a lot of those headlines, it was almost schizophrenic, right? Over the course of literally 11 days of headlines I read, it went from excitement, euphoria to fear into the world, right? All over the place. The reality is a lot of the headlines, there's nothing you can do about it. Not a thing. So what I want to talk about when it comes to your planning, your strategy, and your retirement, what are the things that actually produce a result, produce an outcome, something that you have control over? And here's, I want to show you this. This is called an advisor alpha study, or it's research. And what it's really showing is what are the things that can be done to improve your outcomes, or when we're talking about investments, your overall returns or results. And if we look at this, you start at the top, suitable asset allocation. You see there's kind of minimal asset allocation. What is our ratio to stocks and bonds? Equities to fixed income? Very minimal impact on you outperforming. What about if you're really conscientious and proactive on cost-effective expense ratios? Okay, 30 basis points, 0.3%, right? 0.03%. So it starts moving the needle, rebalancing. Do we have a system and process in place that once we've identified what is that market portion in our timeline that we can afford, that after our income plan is secure, we can get those higher averages over time? If we have a regular recurring rebalancing system in place, again, can move the needle, give us a return above what the market does. What about behavioral coaching? Now, really, what's fascinating, that 200 basis points, that's up to 2% improvement. The biggest needle mover of anything we're going to talk about, and that's behavioral coaching. You know, as I'm sharing that, I realize this whole presentation really is a lot of that. It's having these conversations, right, around, well, what does it feel like doing? What does it feel like I should do? Am I healthy? Am I in danger? Do I need to make adjustments? And you talk through it, and you get to a place of clarity where the emotion's not so raw, and you can make good decisions. Okay, that's behavioral coaching. And just by having, and I'm doing this mass, right? This is for everybody, and this will go out beyond this live presentation. So this is mass conversation on the behavioral side, but that sometimes this is exactly what we need to do. Sit down, let's talk through it. Let's have conversations. Let's make sure we don't have any blind spots, right? Behavioral coaching, asset location. Now we're going to talk some about asset location, whereas asset allocation is what is your ratio of stocks, bonds, right? Equities, fixed income. Asset location is where in your timeline are your different kinds of assets. Does it matter where you place your more aggressive assets, your safer assets? Where do they go in the timeline? What is the location? And how do you put them in the right location for the best result? And by the best result, it's the most use of your assets, your money, over your life expectancy. Okay, asset location. We'll talk more about that. And then we talked a little bit about the total return of the market versus income planning. But those are the things, when put together, they actually matter or move the needle or make a difference. So anything we're thinking or anything that we're hearing or anything that's outside of our control that we're spending energy and bandwidth on, right, it's not helping. So I think one of the big questions I have, and it's a question I ask myself, and this works in any area of life, whether it's your finances, your relationships, your health, is before I spend my energy and bandwidth, because it is limited for all of us, it's finite, am I using what I have, that energy I have, that bandwidth I have, am I making sure I'm using every bit of it on the things I can control? Okay, so I wanted to talk about the things that move the needle, and here's a good visual illustration, right? Just talking about the things that move the needle with retirement planning, the things that matter, the things we can control, and there you go. These are the things our effort, our energy, and our focus needs to be on, and not distracted by the emotion evoking headlines. Helpful? Has this conversation so far? I'm hoping to hear just so far as we start to talk through it, we start to calm it down a little bit. We're going to get into how we do this. How do we map this out so that I'm immune to some of the things I'm worried about or concerned about? Let me know. Has this been helpful? You see the value in having these conversations, slowing down, stepping back, talking through. And if we do that and we identify some things need to be adjusted to be healthy, to put yourself in a stronger position to avoid potential pitfalls or blind spots, we're much more apt and likely to do that when we talk through it and walk through it in this process. Okay, so how do we plan for the certainty of uncertainty? Many of you, most of you that have gone through our roadmap to a rich life retirement or roadmap to a successful retirement framework, you've gone through a bucket planning process. And in the bucket plan, if you look at it, it's really what we call timeline segmentation. So your bucket to the far left is the nearest point of your timeline, right? And that is our first bucket. That's where we're going to account for things coming up in the next 12 months. That emergency reserve, a lot of times we like to see 6 months income reserve, and then planned expenses. So say between a trip and some home improvement expenses, I have another $30,000 that needs to be accounted for in the next 12 months. That is bucket one, okay? Reserve and planned expenses. Bucket two, and that's this is the part that really starts protecting and building this thing very systematically in a structure that you can have the best of both worlds, dependable income and participate in market growth over time. And you're not guessing and you're not gambling. So bucket two, we're protecting the timeline, meaning we're identifying what are the income gaps with your puzzle pieces. You know, you have Social Security benefits, some of you have pensions, some of you are going to work part-time for a little while. So what are the gaps we're filling? And what is the gap that needs to be filled to make sure that even if the market's crazy like the last 2 weeks, month in, month out, year in, year out, I have that income available, whether the market's up or down, planning for the certainty of uncertainty, because we don't know when the market's going to be up or down. We just don't. So that's protecting and that's going to really function as your income plan. And you're protecting that first segment of your timeline. And then that gives you the ability to go further in the timeline. And your bucket three is, okay, these are the assets I can have exposed to equities, to the market, so that over time I'm getting higher averages, and you should, because you get higher averages when there's more volatility. But the way you de-risk the market is you buy time. So by making sure that we're properly segmented, we have the right ratios, it's math, right? A phrase you'll hear a lot around our office, the math will show the path. I'm gonna have some t-shirts made. I think we should start giving that. So the math will show the path, meaning this is not just a random, well, put half here, half there. Let's solve. What is the income gap? What is the asset it'll take to solve the problem, the income gap? And then how is it structured so that it creates dependable income? That's going to be more your fixed income sources, your bond, think of your bond, fixed income alternatives. And then our third bucket, we can confidently now, once we bought the timeline, stay invested, completely invested, ideally, for higher averages over time, which is going to help in the long run with inflation and purchasing power and longevity, a lot of the other risks. So I think a way to think about this concept or this conceptual model is think about maybe, let's just say you're 60 today, either stepping into retirement or approaching retirement. Was a market drop as scary as what you just felt today at 60 years old at 45 years old, 15 years ago? It wasn't. Why? It wasn't as scary because we had bought time, or we had time on our side. We had 15 years for the market to do what it does. This is money for later. This is retirement. So what we're doing when we segment the timeline is we're doing the same thing. We're just buying our timeline. We're securing it for a period of time. And that way, you're not jumping back and forth. You're not guessing. You're not letting emotion dictate your strategy and hoping you're lucky. You're mathematically, systematically building an income plan, and you have a growth plan, and it's both and, not either or. Right? Either or is guessing what you think you should do based on what you think the market's going to do. There's too many variables for us to know exactly what and when. So that's the concept of the bucket plan. And if it's structured properly, and we go into all these headlines, right? These headlines I talked about, you're really immune. Now, it might not feel good. You might get caught up in it because there's a lot going on, a lot of energy, and a lot of emotion around it. But your plan's still going to hold up. And when you go back and talk through how you're structured, hey, my plan was built for this. So a good question to ask is, do you feel confident that your timeline's structured properly and that you can say that sentence, my retirement plan was built for this, right? A little different than the story and message you're hearing out there. We go on from the bucket plan. We talked a lot about asset allocation. I mentioned the term asset location earlier. And we talk about what kind of assets, as far as tax perspective and as far as the volatility of the assets, does it matter where they go, right? Does it matter if they're pre-tax, after-tax, tax-free? Does it matter if it's in my account at the bank, if it's in my 401k IRA, or if I've got it converted to Roth? It does matter. The results and impact in the use of your money, paying less tax over time, your money lasting longer, asset location is going to be a factor. It's not random. So if we look at this line here, again, this is your timeline. We typically are wanting to put your least tax efficient, meaning your taxable accounts, think savings accounts, interest bearing, even dividend bearing accounts that you're paying tax on every year. Those are your least tax efficient accounts. We typically want to have those earlier in the timeline. Right? That's why you'll see savings account CDs filling that first bucket often, right? Tax deferred accounts, that is, we want to shift and invest, if possible, some of those taxable accounts. Can we get them repositioned a step in the right direction to tax deferred accounts, right? Because the yield on an investment is going to be much higher if it's not taking interest out every year. If it can compound, and then you're at some point paying tax on the money you use and spend. And then the third is think of Roth, and there's some strategies with cash value and life insurance where we transition from tax deferred accounts, or we fund to have buckets of money that are tax free. Right? So that's in the timeline where we want to think about the location and the types of money and the way it's taxed. What about the way it's invested? Okay, and then if you go under here, right? Typically, if it's my reserve account, my reserve income, my planned expenses, you want to be very conservative. Again, think savings account, CDs. And that's been, we've been very fortunate the last few years with interest rates peaking, that we've had some nice interest rates for money to sit. Now, you're going to see that continue to come down over time and get more to a long-term average. And if you're paying tax out of that money every year, is growing, the interest rates are dropping, you're paying tax, it's growing interest rate. And as things level out, you're going to run into problems with inflation running that money. And that's why we want to see, can we reposition, or is that money we can use and plan to use within that first initial 12 months? Now, on the other side, think my Roth IRAs, money growth that will never be taxed. I want that to be the piece that I've intentionally positioned with the highest market exposure, because over periods of time, that will give me the highest return. Right? So I want to grow the biggest and grow the most, the piece of money I have the most time on, because I want to pay the least tax possible on the biggest piece of money. Okay, follow me? Asset location, another concept. And if this is a newer concept, sometimes there's so much emphasis on asset allocation that where we put certain kinds of money from a tax perspective and from a volatility or from the aggressiveness of that type of money is not talked about, or it's not really built properly into the plan. So as we go through these things, and for clients of ours, right? If it's something, hey, I don't know that this conversation's been clear to me. Maybe we need to talk through this. I want to make sure I feel buttoned up here. Make a note, ask a question. That's what today is for, is just to talk back through, how do we build these retirement strategies that put you in a position of controlling what you can control and immune from some of the things that other people that don't have that are more of that guessing and gambling type of strategy, hoping everything works out okay type of strategy, are not going to have the benefit of. Okay, so there you go. So now you see these all fit together. The bucket plan is simply a conceptual model to help put the pieces of money on the timeline for specific jobs, right? First bucket, planned expenses, reserved income, tax deferred account. Ideally, especially, we need to get, if you get to retirement with big buckets of pre-tax money from 401ks, IRAs, we need to deal with that money. Meaning we need to either spend it or see if we can convert it in the timeline, convert it to a Roth. Because if we don't deal with that money, we leave it in that third bucket and let it compound $500,000 a market cycle, 10 years or so, you're going to have a $1 million problem. $1 million today, 10 years or so, it's going to double plus, and you'll have a $2 million tax problem. And then as your timeline shortens and as you get closer to 73 to 75 years old, based on when you were born, then you could find yourself in the position to where we don't have the timeline to work on this and address the issue. And you're running up against a wall with required minimum distributions from these accounts that you're forced to take. And a position you don't want to find yourself in is being forced to take money you don't need and pay tax on. Let me say it again. We don't want to be in a position because we got busy with life and time. How fast does time go by? 5 years went by, 10 years went by, and now we have a much bigger tax problem, and we're forced to take money we don't need and pay tax on it, whether the market's up or down. Okay. You'll hear it called a tax trap, a tax torpedo. So we need to start addressing that in the timeline. And many of us get to retirement with buckets of pre-tax money because 401ks are where we have the opportunity to save for retirement. One of the things you'll hear me talk about a lot, and this is a class coming up that I want to invite you to, is we talk a lot about Roth conversion strategy. So how do we deal with that pre-tax money? Again, we either spend it or we look for the opportunities every year. And the goal is by 12/31, because it has to be processed and dealt with by 12/31 of the year. Here's the income for the year. Here's my next tax bracket. Here's the Medicare surcharge or the IRMA threshold that I need to be aware of, and see what opportunity the market might give us or the economy might give us that year to reposition some of our heavier tax money, because it's just going to grow heavier taxed, to reposition it to a place that'll grow tax-free. Roth conversion strategy. The key with that, and again, that's a whole different class, so I don't mean to go down a rabbit hole, but the key with doing that work is being consistent, making it a priority, making it a part of your retirement planning, year in and year out. It's like chopping down a tree. Don't let a year get by to where you didn't at least look and assess, is there an opportunity for me this year to put myself in a better long-term tax situation? And let's think about this. It goes beyond you. For those of you married, what happens if we keep that pre-tax money, we don't deal with it, and our spouse inherits it when we die? There's such a thing as a widow's penalty. It's called a widow's penalty. You'll hear it around our industry. And what happens is that surviving spouse now inherits this pre-tax money, and it costs them more to use the money. Or another way to say it, they can use less of that same money because the standard deduction got cut in half. You drop from the most favorable tax bracket to the least. And now you not only typically have a reduction in income in the household when a spouse dies, the tax burden goes up for that surviving spouse. Now, what do we do about that? Again, when you die, someone planning for that certainty of uncertainty, we have a Roth conversion strategy and we start addressing it in the timeline. So for many of us, when we start thinking about these things, that window from late 50s, early 60s into that 73 to 75, that is a beautiful time frame to be getting some of that lifting done. Doing it incrementally, because if we wait till it's the perfect year, we can do the big amount, it's growing faster than you're doing. So again, I digress. I get excited about tax planning. So follow the rules. So, okay, so we've identified our liquid money and planned expenses. We've talked about getting rid of pre-tax money as either money we need to spend to fill gaps for income, if we have them, or we need to shift them back to our third bucket because I want to grow the longest and get it converted to a Roth. But you have to do smart conversions, meaning you don't just say, hey, I love all the benefits of a Roth IRA, so I'm going to convert $1 million. No. Again, you gotta look at it, You've got to look at the tax bracket, look at the thresholds, and do smart conversions over periods of time. But every year, don't let a year go by where that opportunity misses you. So now we're to the third bucket. So we've secured the timeline with the income we need to cover the income gap. And we adjust and have conversations on that every year. Okay, what's changed since last year? What do we need to account for going forward? And once we know the positioning of our growth money, and this is the market money, this is the money that's in the news right now, right? How do you build a portfolio? Do I chase what did good last year? How do I build a portfolio that can give predictable results over time? Because if you're going to take some risk in the market, what you want to do is be able to plan with some certainty over periods of time what this is going to do. What are some of the what are the outcomes that we're moving towards when we have a proper investment allocation in the proper section of the timeline or the proper bucket, if we're talking bucket planning. And I'll tell you exactly how we do that. All right. You need to be in a rules-based investment system. What does that mean? Well, rules-based investment system, it's just like it sounds. There's rules that if we don't violate those rules, we are going to get the market growth over time, higher averages over time, and we're not open to pitfalls, gaps, and the wrong thing. So let me read. So here's the RichLife Advisor rules-based investing system. 5 rules. Tell me if you don't agree with them, because I find them hard to disagree with. Because again, if we follow these rules, we're going to get market returns over time, or market averages over time. Number 1, we need to have an emphasis on investing in a way that minimizes taxes or controls taxes, minimizes it where we can. Again, it's not just the growth; it's the net return, it's the net income, it's the money that you and your family can use and spend or inherit or donate. Right? Control taxes, minimize fees. If we're going to structure this portfolio, there's a wide range of how you accomplish following these rules and what the fees can be on that. So are you in a situation that minimizes fees where available? Number 3, I spent a lot of time on this in the beginning, remove emotions. When we step back, can we revisit this plan? Can we revisit the timeline? Can we check in on the rules? And can we know we're working on a system and a plan and it's built to deal with humans and to deal with uncertainty? Number 4, reject gurus. And you could put hot takes, noise, sound bites, the hot stock of the year, because if we start getting into that fear of missing out, this is what friends at work said happened with their account, or this is what so-and-so said that was on the radio show or on MSNBC, whatever it is, we're starting to get off of our system, right? We're starting to really start reacting with emotion. It's making us make a change or make a difference. And then number 5 is stay diversified, and we diversify across multiple sectors of the market, so that what it does when you have different asset classes acting differently, it reduces risk and over time actually increases your results. So 5 rules. Anybody here? Everybody here, these rules make sense, right? And do you see how that if our structure, when we're deciding how an allocation of a portfolio or to get market growth over time follows these rules, we kind of know. Now you don't know to the percentage point but you know what to expect over periods of time. We're growing our money the right way, and we're getting the higher averages over periods of time. Behind the rules, we talked about the philosophy behind that. So do I have a rules-based investment system for my market assets, my growth assets? We believe in global diversification. We looked recently. One of the best performing portions was some of the international allocation we had. So we're diversified across the market, across the world. Blending low-cost core, right? The beta, if you hear the term beta, right, that means you're getting the market when it's up and is tracking the market over time. Then high conviction tilts. And that is when we have our monthly investor committee meetings, we're taking into account all those key metrics that came up earlier: inflation, GDP, interest rates, all those measures, and we're making decisions. Okay, based on this economy, what's a portion of that overall portfolio that we're doing high conviction tilts to outperform that beta, right? Or potentially outperform that beta. We believe in using exchange traded funds for a lot of the reasons in our rules. They very cost efficient. They're tax efficient, and we'll run into scenarios to where we're comparing different models and different portfolios, and you'll see, again, wide range of fees, and a big difference in fees has a big result on the fee drag or the overall results over long periods of time. Rebalancing, we talked about that as one of the things that can create alpha in the portfolio. Is there something happening that is systematically rebalancing to make sure that your portfolio is staying in a line? Probably for a lot of us, after this last run up in the market, and there's been a drop in this last couple of weeks, but we still probably have some growth that might need to be rebalanced somewhat. Right? Is there some mechanism, some system, some process that your assets in the growth portion of your market portfolio are being rebalanced? Right? Or is it just happening when you think about it or when somebody recommends it? And then number 5, goals-driven strategies. Right? A lot of this has to do with your goals. What is your objective for this money? What is your risk tolerance? And it's specific to you. You'll see in our roadmap model, before we get into all the components of a successful retirement strategy, we have to start with who are you? All right? What do you value? What are your priorities? I like to ask in terms of what's your definition of a rich life? What is it to you that's meaningful and fulfilling? I can't tell you that, but if we have a conversation to get clear on that, we can then go back and use your assets as a tool to build a strategy to move you toward that. Right? That's what I think financial planning needs to be. It needs to bring the human back into the model. Okay. So investment philosophy, again, one of the keys. So once we've done that, we have our rules-based. We're not making wild gambles, wild guesses. We have our structure, we have our system. Rules are in place, our philosophy is intact. Then the key is in that bucket of money that has mathematically been determined to be the growth bucket, we stay invested, right? We added this chart here because if you look at this, 7 of the 10 best days took place in bear markets. Right? In 2020, the second best day happened immediately after the second worst day. And that last bullet point, investment returns are 93% lower if the 60 best days in the market are missed. Right? So this idea of when it's scary, I move out and then I'll get back in when it feels better, that's human nature, right? We're hardwired to protect ourselves. That's human nature. But when we structure the timeline, we structure the allocation, we structure the location the way we're supposed to, then we need to say, okay, this is the job of this bucket. This is the market piece. Again, this is the piece that's in the news right now. Stay invested. Current opportunities. So here's something. I always pay attention to when you might hear all the negatives, everything sounds awful, everything sounds bad. Every economy, every market gives us opportunities too. So what are some potential opportunities that maybe we think about? And I encourage, as you're listening to this, maybe make a note of saying, oh, okay, that might be something that applies to me or my household or something maybe I haven't thought about. So what are some opportunities? Because we don't just want to freeze up and miss something that might actually help us in our results and our retirement long-term. Tax planning, right? When the market is volatile, especially in those downturns, it creates extra room or it allows us to do bigger Roth conversions. So what I mean by that is if a stock or an equity portfolio is down 20%, it means for the same amount of tax money, I can get 20% of that money shifted into the forever tax-free bucket. Right? Now, the only assumption we're making there is that eventually it comes back up and grows again. Right? That's the one assumption you're making for that to be viable. So down markets are a good time to look at your Roth conversion strategy that I talked about earlier. And one of the things we've been having some conversations about at the RichLife office is we start doing tax planning earlier in the year. and say we know what your income is going to be for the most part, and we determine there's an opportunity this year to do a $40,000 Roth conversion from pre-tax IRA to your Roth. Markets dipped, might be a great opportunity to maybe do a portion of that. You could do the whole thing, but maybe do half of it and then revisit. Market drops some more, sooner than later, do the other piece. Or we wait and just make sure we do the rest of our healthy conversion by 12/31. Okay? Same thing with after-tax money. If you have some losses, you could do some tax loss harvesting in your after-tax money. You're offsetting gains and losses. And if you do that correctly and you do that, you don't want to let the year get by where you could have taken out money that offset at a 0% tax bracket. If you can take money at a 0% tax bracket, you want to be aware of it and you want to redeploy that into your strategy and plan. So a couple of opportunities with tax planning. Deploy cash when the market drops. If we've been sitting heavy on cash, or I know in some of our allocations, we had a little bit of a cash position, intentionally knowing that with an overvalued market, that when it drops, we can redeploy cash and be better positioned for when this thing works itself out in the upside. So it might be a good opportunity to redeploy cash. We talked about this a few times, rebalance. When's the last time I checked on the allocation of my portfolio? There's been a lot of growth the past several years. Is it out of allocation? Or if I have my income plan properly structured in that middle bucket or that second segment of the timeline, do I have too much really inappropriate fixed income over here? Because if you're going to, if you have the time, you can afford to take some more risk. So some of that's risk tolerance, but some of it, people are more conservative in their growth planning than they intend to be. And it's fine if that's your decision, but make sure it's what you intend to be. So is there opportunity to rebalance? Adjust risk, right? Maybe we've talked through some of this and it's okay. As I'm closer in my timeline, a little further in my timeline, do I realize I really need to pull another $1,000 a month of available income into my middle bucket, which would shift you a little more secure on that portion of your assets. And or, like I was just saying in that last example, do I have too much conservative allocation in that third bucket that really could be addressed for long-term growth? Because remember, you're not losing anything until you cash out or sell. And really the last thing is as we're going through this, and for those of you that are our clients, we talk about our route, the route to a successful retirement, the roadmap to a rich life. And the route, right, it's the components of a successful retirement strategy that need to be integrated, working together. There are 5 unique plans that are integrated. Risk, risk. That's what we're talking about with the market risk. O is an optimized income plan. U is unexpected medical expenses, conversations we need to have. T is the tax planning. We've been kind of talking a lot about that and not missing opportunities. And E is your estate plan. So are there any of those areas that, maybe as we're stepping back and we're starting to have some conversation, you're thinking about it, that you wouldn't say, on a scale of 1 to 10, out of income, growth, healthcare expenses, tax planning, estate planning, income growth, health expenses, tax planning, estate planning. Out of those 5 core areas, on a scale of 1 to 10, are there any of them that I don't feel like I'm an 8, 9, or 10 and pretty buttoned up? That might be something we talk through, right? And again, I'm talking to those of you who are our clients. Maybe there's an area we're saying, you know what? We have the timeline secured. We built it right, and we're aware of that now that we're seeing some of this volatility, but we never got that estate planning document in place. Okay, well, let's make sure all these things are buttoned up so that one thing, right, the certainty of uncertainty, one of those uncertainties doesn't blow up the plan. So is there anything we need to revisit in the overall retirement strategy? Some resources. I promise you resources. How's everybody doing, by the way? I started the conversation with how's everybody feeling. We talked about a lot of stuff. I know we've gotten into some technical, some tactical, emotional. Everybody doing okay? Okay, good. Any questions so far? You start populating them, and we're going to get those questions, and we'll start answering them here in just a few minutes. We did promise we had some resources to help with this, right? Keep your eye on your inbox. So if you register for this recording, I recently on the Rich Life Retirement Show had a conversation with our chief investment strategist, Jay Coulter. And there's a percentage of you that like to get into the weeds and talk about the indicators and the data behind the charts. Check out that, look for that conversation with Jay, right? He's going into what's currently going on, what kind of positioning's been done in this market, and what we need to be paying attention to. So look for that. Anybody you think that might benefit from this conversation we had tonight, that might be helpful, or has questions, or needs to have support around some of these areas, share this recording with them. You'll get a copy of this, share the webinar. Something I have coming up, and I have a hard time not going down a rabbit hole, and I started a little bit today. We have a training coming up, a webinar on the retirement tax trap, right? It's tax planning in retirement, what most retirees get wrong. So we've talked some about with the market, the timeline, some of the things that apply to tax planning, Roth conversion strategy. But what are things that you could have as a checklist that these are things I need to look at, address if they apply to me, make sure you're doing everything you can to have the lowest lifetime tax bill possible. Because for many of you, it will be the difference in hundreds of thousands of dollars of extra revenue or income you can use and spend by paying attention and being proactive with the tax planning. So look out for those. Additional things, again, ask yourself, I think this is a great time for an honest self-assessment. Does the asset allocation location, did any of that resonate with me? Does any of that need to be discussed further? Am I using timeline segmentation? Do I have a written income plan that hits all the gaps, and that it's dependable income, that even if the market's down 30, 40%, I know my plan still holds up? Do I have an investment system, talking longer term in that third bucket, that's rules-based to get the benefit of the market, but with some predictable structure by following the rules? Am I paying attention in those opportunities? Are there tax planning opportunities that need to be looked at? And one of the things Anna was going, Anna, you're going to put this in the chat, right? Or you're going to put this?
I can go. I'll drop it off.
Okay. So we have a market correction issues checklist. So again, just another good tool to say, okay, is this something that's buttoned up or something that's a concern? A self-assessment, because a lot of times when we do these, you'll hear me talk about self-assessments a lot, because when we do that, we're stepping back and saying, okay, here's an issue that I don't need to put focus on. Here's an issue that I need to maybe have a conversation. Maybe start having conversations with my significant other, whatever that looks like. So look for that 2025 market correction issues checklist and see if you're vulnerable to any of the issues that could come up. Or a lot of cases, why I do this too, is you might say, you know what, I'm actually positioned in better shape than I thought. It felt weird, but now that I see it and I have the data and we've talked through it, I feel pretty good, or I feel much better about it. So look for that. I want to make sure you're equipped and have tools. Now, we talked through this. I talked about the route to a successful retirement, the roadmap to your rich life and retirement. And again, any of those conversations when we're going through this are fair game, right? What's on your mind? What's the biggest priority? What's the biggest urgency? We're spending a lot of time on risk because we've been dealing with a market that's been volatile the last couple of weeks. But where does it fit in? And do we have plans for all 5 of these areas? And are they working together? Right? They're not plans in a vacuum or decisions in a vacuum. They're all working together. That is the key to a retirement plan built for the certainty of uncertainty. And you notice at the top, our model is very specific and very intentional. We can't start talking about the tactics and the math and the strategy, again, until we're clear on you. Starts with you. Every year, every time we review, every update, every life change goes through you, who you are, your priorities, what you care about, your values, and utilizing your assets as a tool to provide and protect for your family and live your definition of a rich life. So again, I hope this has brought some context to conversations we have all the time. And what's funny is some parts of this conversation we have in good markets to kind of temper things. We have in volatile markets to remind ourselves and remind each other and remind the people that reach out to us what and why and how we're controlling the things we can control. And that's where our energy goes. Because I don't know about you, I don't have energy. I don't have much energy beyond that. I put everything I have into the things I can control. So in conclusion, right, how do we get through this? Couple takeaways. Markets are uncertain, but your plan can be built with certainty. Markets are uncertain, but your plan can be built with certainty. And I'm going to add, and not luck. If we don't have this certainty built in, we don't have all these things we're talking about built, and a lot of times our financial plan, our retirement plan is, I hope I'm lucky and things work out okay. And we can do better than that. We can be more precise than that. Second thing, long-term strategy, building it right, staying the course will outperform short-term noise. Okay? And a big clue is data versus emotion. And sometimes there's nothing wrong with emotion. It helps us and serves us too. But sometimes when it comes to things, in particular our money and our life, our life savings, stepping back serves us well. Spend a little time with that. And we're here, Rich Life Advisors. I hope you got the gist that we kind of talked about several areas of retirement planning, things going on, but we're here to educate. We're here to support. Always, you have an open invitation. Reach out to us. Let us know what you need, what you could use resources on. If you would like training on another topic that came up or that didn't come up today, and we'll continue to share. And again, the one coming up that we have that I want to invite you to, and you'll get in the email follow up from this, is our tax planning strategies for retirement class. So join us for that. That's one of the big ones. If we can shift proactively doing yearly retirement tax planning, one, you're going to be in rarefied air amongst your peers, but two, you're going to get much better use of your money. And again, I'm going to say it the same way, and utilize your assets to provide and protect for your family, yourself, and really the people you care about the most. So with all that said, I feel like we did a whole retirement planning conversation all the way around tonight. Did we bring up any questions? Or if you don't have questions, any insights come up tonight? An insight could just be, wow, that's something that I probably need to have a conversation or I haven't thought about, or disagree, anything you disagree with that you want to talk about. So anybody have any questions? And while we're looking for that, if you need anything from us, again, look for your email, look for those resources, look for the radio show from Jay Coulter, me and Jay Coulter, talking about the market and portfolio allocation, location, a lot of the things we talked about today. You have your retirement checklist here, and you'll have the access to that, and you'll have an invitation to our tax planning and retirement webinar. If you need us, call the team, Rich Life Advisors at 770-249-7424. That's 770-249-RICH. And if you prefer to email or have something you want to send over, send to info@richlifeadvisors.com. And I will leave that up there. And Anna, if we didn't have any questions, I've had some thumbs up, agree.
We have a question from Lori.
Okay.
I'm gonna go ahead and put that on here. Also, one last thing, the guide, I didn't put it on the chat, but it will also be included in the email that we'll send out at the end of this week with the recording of this webinar.
Got it. And I have a question. A year ago, I wanted to transfer part of my 401k to middle backed and did not. Now I'm regretting that. Is it too late to do that? Do you see who that was from? I'm just seeing.
Lori.
That's Lori. Okay. Lori, it's not too late. And it's a very similar conversation is that if we look over 10-year periods of time and we take a portion of equity exposure and diversify it into into something like metals. When I was talking about earlier, when you have more assets that act differently, it actually reduces risk and will often give us a better outcome over time. Now, where we have to be careful is picking and choosing, because we tend to have a very bias to a recency bias, and oftentimes what will happen is we go into the thing that just has done really good the last 5 or 10 years, and we get out of the thing that's kind of beat up and an opportunity to grow. So I think that the question is, no, it's not too late, because again, it's a long-term position. Do we want to have 10% position, 5% position, whatever that might be in metals, and then facilitate doing that? And one thing for those of you that do metals, I tend to prefer tangible physical metals, and there's reasons for that, and that's a conversation beyond the scope of this. But to have questions on that, and kind of, it's just like we're talking about reallocating the portfolio. Do we want to diversify further? Rarely is it a bad idea to diversify further unless we're in a growth portfolio and we're diversifying into bonds. That's probably not in your goal. So Lori, great question. If you need some help with that, or just want to talk through that some more, let me know, and I can certainly point you in the right direction. Jim, try not to pay attention to it all, in it for the long haul. Love to hear that, Jim, because that's the key to success, is that this is a long-term plan, a long-term proposition. The market's going to go up and down, and it's me being in it when it's down that gets the biggest gains when it comes back up, right? And not guessing and choosing, but you do have to be properly structured to make sure we're not in a position to where I need $5,000 of income to live my life and I'm overexposed. It needs to be mathematical. So great. Anybody else? Great feedback. Thank you. Yeah. So again, I encourage you, send questions in. Let me know if there's anything we can do to help. If there's any conversations that you want to have around any of these areas, we're here for you. And again, a lot of times when it comes to all this volatility, all this news, all these headlines, let's step back and ask ourselves, are there things we can do to improve our current situation, de-risk the situation potentially in the risk conversation, and control what we can control? That's really all we can do. And then we can put a lot of that energy on living that life that I know most of you, I hope all of you, look forward to retirement to do some things. Spend time with people you care about, create memories and experience. Right? And that's what I'm hoping we keep as much energy freed up as possible to do. Because really, at the end of the day, if we're not using our assets as a tool to do those things, there's a really good chance we'll look back one day and realize we missed the point of it. Again, we're here for you. Let us know if we can help. Thanks so much. Bye, guys.
Thank you, everyone.
Thanks, Anna.
See ya.